Good morning, and thanks for joining us for our webinar this morning on the Fall 2016 Crop Outlook. I'm Jim Mintert, Director of the Purdue Center for Commercial Agriculture, and joining me are my colleagues Dr. Chris Hurt, Professor and Extension Ag Economist at Purdue, and also Michael Langemeier, who is our Associate Director of the Center for Commercial Agriculture and also a Professor of Ag Economics. We're going to spend a little time today talking about the outlook in light of the updated information provided by USDA yesterday. USDA, of course, released an updated crop production estimates in their crop production report, and also updated world ag supply demand estimates. And so, Chris, let's kick it off because I won't say this was unexpected, but certainly a confirmation that we're looking at some record supplies with respect to both corn and soybeans, right?
Well, that's right. We still have to use the word record in front of this crop and these yields. But as we look at the corn yield, especially here, we gave something to the trade. The trade were really doubters of the 175 back in August, 175 bushels. So the trade got something here. USDA did lower to 174.4, so 0.7 of a bushel lower returns, lower yields. And so the trade felt that was a reasonable number, I think. But still, as we look at those yields, record yields exceeding the 2014 yield at 171 bushels. Again, we have some I think other information we can get from this chart, especially when we look back, we can see the 2012, the big dip over on the right-hand side with the major drought that we had. But if we follow that back a couple of years to the 10, 11, and 12 crops, all of those were below average yields, at least trend yields, and especially 11 and 12. Now that was coming at a time when we had this robust demand. We had the Chinese demand for beans growing so rapidly. We were still at least in 2010, fulfilling the renewable fuel standard in terms of the ethanol mandate. And then we had low yields. Now we're kind of on the other side of that. We've seen the dollar appreciate substantially, makes us harder for us to sell in the world market. We've leveled off the corn ethanol demand growth. And the Chinese rate of growth of soybean purchases still strong, but has slowed. And then we get these 3 years in a row of very good yields. So there's no question that the depressed prices we have are certainly related to these very good yields, above trend yields, and some of the extremely high prices we had back in 10, 11, and 12 were related not only to the strong demand, but also to these smaller crops. Big crop, it's a record.
So we combine that with relatively large acreage, gives us a record size crop, over 15 billion bushels.
That's right. So we have a 15 billion bushel crop according to USDA. That's almost 1 billion bushels higher than our previous record with the 2014 crop. So this is pretty remarkable when we go back and think about around 2005, 2006, as we started into the huge growth of ethanol, corn use for ethanol. We were producing around a 10 billion bushel crop. So now we've hit a crop of 15 billion, a 50% expansion. Amazing what American farmers have been able to do, but we've seen the consequence in terms of price as well.
And it takes us back, in some respects, back to that 2005, 2006 era in the sense that we put about 5 billion bushels into ethanol each year. Take that away, and from a total supply number, not that far off from where we were.
That's right. And again, we're basically looking at, as we look at inventories and try to measure each of these crops against each other, how much do we have left over at the end of a marketing year? And so that's kind of where we're going to be. We're looking at roughly decade highs, the last decade highs, 10, 11 years on corn and soybeans in terms of inventories that we have.
So let's take a look at those ending stocks relative to usage. And you've looked at that for all the major crops?
Yeah, and again, the green line at top is the wheat. This is what we call stocks to use, or the ending stocks at the end of the marketing year as a percent of a full year's use. Now, if we can get all the way, our eyes focused clear to the top, 50% approximately of a full year's use of wheat at the end of next May that we're going to have left over when we're starting into harvesting another crop in June and July. So that, of course, in this time span, which goes back to 2000, are very high inventories. And that tells us that in terms of the U.S., our biggest problem of the major grains would be wheat, problem being with a surplus situation. And that's an extraordinary number. Now, that would suggest to us that probably wheat prices will be depressed. That would suggest to us that there probably are better alternatives for some than wheat in the United States. And of course, what we're saying is wheat acreage more than likely will be down for 2017 as farmers across the country look for something else to plant. But let's get down to the ones that are more important here in the central Midwest. First, the blue line, a little hard to see, but we're stocks to use 16.5% projected from this 16 crop over on the right-hand side. Again, we have a horizontal dashed line that takes us back to around the 2006 crop. We're higher than the 2006 crop in stocks to use, and we'd have to go back to 05. So really looking at something over a decade that these would be the highest inventories of corn. So when we talk about inventory problems, supply problems, wheat is in most desperate surplus. Corn would be second. Corn and wheat are somewhat of substitutes for each other in terms of feeding of livestock. Not perfect substitutes, but wheat can come into the ration. So this tends to tell us in more corn country that wheat is going to be a drag on corn as well this year. Let's go to the very bottom line, that's soybeans. And after some very tight inventories the last few years on soybeans, jumping with this massive record crop this year up to a 9% stocks to use in this 2016 crop. That would be the end of August 17 when we get to that point. And carrying that dashed line, red line back would be the 07 crop. This is higher than the 07 crop in inventory. We'd have to go to the 06 crop to see higher inventory. So again, something in that range of around a decade since we've seen this high of inventory. So in most surplus, wheat, second would be corn. Soybeans are the ones that have not quite as dire of situation, and probably see some shifting towards soybean acreage in the United States next year, out of wheat, out of corn.
Chris, let's take a little more detailed look at the balance sheet. You've worked through not only the USDA numbers, but maybe some projections of your own or some modifications.
Yeah, these are actually
USDA
just
numbers.
the USDA numbers. Again, that data is fresh, and we probably would not change too much on here. I think let's just look at the 15-16 crop. The only change made yesterday was on the exports, and that was on corn, dropped 10 million bushels to 1915, and that all went into the carryout. The 17-16 or carryover was increased 10 million. Of course, those are just very small changes. USDA has an estimate of 360 per bushel for that 15 crop. Now that has some significance for our government program payments. 360 would be the marketing year average price, and that could still be adjusted probably no more than a penny or maybe two, and that would be based upon the final August cash price received by farmers. That comes out in NASA's publication, Ag Prices, right at the end of September. So that's when FSA can finally get that exact level of the marketing year average price. But 360, and let's go back to the 14 crop. There's where our prices really fell down to 370. So 370 in 14 crop, 15 crop, 360, basically the same. Now let's look at this year's huge record 15.1 billion bushel crop. So the carry-in was increased by 10 million bushels, as we said. The crop was actually reduced 0.7 of a bushel. That came out about 60 million less bushels of corn at 15.1 billion. So these are hard for me to even say these numbers. A total supply of nearly 17 billion bushels of corn. That has hardly been a number that could be in our vocabulary until just recently. Almost 17 billion bushels of total carryover from last year and production and a little bit of imports. USDA, with a little bit smaller crop, did lower the feed usage 25 million bushels. Again, I think many of us feel this is fairly aggressive in terms of that much increase. Our animal units are going to be up about 1.5%, and this looks like a fairly large increase. But again, cheap corn prices very well may really increase the feeding rate, the amount of corn that is fed per animal. The ethanol increased a little bit. Again, there's not a lot of price responsiveness in ethanol. That is, lower prices don't get much more corn use for ethanol. Where it does get some more use would be in the exports of ethanol. So lower corn prices help lower ethanol prices, and that can help us in the exports. But that's mostly mandated at 5.275 billion bushels. And then exports, a robust increase in exports, and obviously we got the number wrong there. So USDA does have over 2 billion bushels of exports, and that looks very encouraging at this point. Now, I think what we would have to say about exports, corn exports, is that we have an aggressive export program going on right now. That aggressive export program was at the tail end of the 15 crop in June, July, and August, continuing on into the early part of this marketing year, September, October, November. That's largely because Brazil had almost a reduction of 700 million bushels of their corn production due to the very dry weather that they had in their late season. So we're picking up a lot of that export activity. And just like we're going to see that on soybeans too, we think corn exports and soybean exports will be front end loaded. We're going to be most aggressive on exports early in the marketing year, September, October, November, up through February, first half, and then could taper off if South America comes in with a normal crop. Let's go to the bottom line, the two bottom lines. Carryover then jumping up to almost 2.4 billion bushels. As you know, anytime you start talking 2 billion or more, the market gets really nervous about surplus inventory, and you're going to have low prices. USDA's midpoint of their range, 290 to 350 for a marketing year average price. The midpoint is 320 a bushel. That was a nickel higher than what they had been in the August estimate. So what we see here is a progression of lower prices. The mid 350s for the 14 and 15 crop, falling to the low $3 then for the 16 crop with this very large crop.
So Chris, the one number that I guess that you kind of highlighted a little bit was the feed usage. You talked about the expansion USDA is projected. One of the things that might argue against that is the competition coming out of wheat, right?
That's right. We're going to probably feed over 300 million bushels of wheat. We hear the stories from Kansas up through Montana of farmers just piling wheat on the ground because of such huge yields this year. And so there's going to be a lot of competition. Quality of that wheat is low in some places, and the best use probably is going to be feed wheat. So there is a lot of competition for corn in feeding, and again, this causes us to think USDA may be somewhat aggressive, or the other way to say this, it would take low prices of corn to really stimulate the feed usage. That's where, since we can't get a lot of response to low prices in ethanol, it has to come low prices to get more usage build up, has to come in the feeding category or in the export category. And we feel like it's necessary to warn people our exports are so strong now because of South American weather problems that we are filling in some of that export capacity that the South Americans were unable to complete.
Yeah, so as you think about it, there's a risk. As I think about the risk of this balance sheet, the risk might be that the carryover could wind up being a little bit larger than what USDA is suggesting at the moment.
Well, and I think we also want to go back to the production number. The September estimates from USDA are obviously more accurate than the August, but I think the feeling is that this certainly is a very good crop. Will it get bigger? So there is vulnerability, maybe several 100 million bushels, that it could even get bigger as we go through the fall. The old adage is big crops get bigger in terms of USDA estimates. Now I think USDA basically gave a good evaluation in both August and September, in my way of thinking, that they saw a big crop, that they weren't going to move towards that big crop, but they went all the way to where they thought that crop was, even in August, and then had minor revisions at this point. So again, how big is that crop? We're just beginning to find out in the southern tier of the Midwest in terms of yields, and generally pretty positive yields. We have some areas of Ohio, Michigan that have some reduction in yields, but then you have states like Illinois that just look absolutely tremendous, with 200 bushel estimate as an average for the state of Illinois.
Let's look at the price chart. You've got a long-term price chart for corn, and you mentioned earlier going back to that 2005, 2006 era. This chart kind of helps us do that, so let's take a look at the long-term prices.
Yeah, and this is, so we've talked about inventories basically at decade highs. And when we think about the boom in prices that we saw and the boom of implication for revenue and farm incomes, let's go back on a little bit to the left of the middle to 2006. Each one of these up and down bars is a month of trading activity. So there's 15 years of trading activity on this chart, and these are futures, the nearby contract. The point is that once we went above about $3 a bushel, that was in the fall of 2006, and we basically have stayed above around that $3 mark since that time. What we see in this chart is we are right back down on that $3. Now this was the September that most recently has traded, and looking at the nearby, did trade down to about 303, I think, right at that $3 mark. Thankfully, we got a bounce off of that. We've got recovery more to the 340 range on the November futures. So hope that that is the bottom. But this is pretty remarkable. I think when we go back and look at the 2006 time period, to think we've been above this level all that time. We're back to those levels. But Michael, I think you're going to tell us cost of production aren't anything like they were in 2006.
They have not adjusted back to that $3 corn rate.
So this is the financial stress that we have going on. And again, if we go back into the left side of that visual, 2002, 3, 4, and 5, we had, at times, you can see $2 to $3 corn, basically. And farm families held things together, but their cost structure was entirely different than it is today. So I think, again, that's a theme we have to think about in our farm economics, and that is eventually we have to get revenues in alignment with cost. Now, hopefully, we are just touching this $3 low again. We've had 3 good crops in a row on corn. Hopefully we can add to that, and we'll talk about corn prices, cash prices, maybe getting back up in the 360, 370 price range. But still, this really shows us a lot of the challenge that we face today.
So Chris, let's kind of summarize the corn outlook a little bit here. You've got some key points you've identified.
In corn, record large crop, but if we're looking for some good news, we do have record usage too. And so it's always a matter of thinking, how big is the crop, how many bushels do we have, and what is the usage of that going to be. Highest inventories in about 11 years. At the midpoint, the marking year average price, USDA is talking $3.20. We expect Indiana storage to be fully utilized this year after not utilized as much last year. We could get some basis erosion, further basis erosion, if we get short of storage at harvest time. Basis, I think, is pretty normal right now for this size of crop. There is the belief that farmers aren't going to sell very much out of the field, at least not much corn. They're going to try to store that. The market carry is about 37 cents out to the spring or summer. Normally we might think that'd be 45 cents, but again, I think the feeling that farmers won't sell at harvest is going to strengthen that basis a little bit, but they will sell lots of volume more into January and then on to the spring and summer, and that'll depress those prices somewhat more. We think on-farm storage returns will be favorable. Cash price range, always dangerous to talk about this, but maybe around the $3 or low $3 up to around $3.70 on corn into next spring and summer. Think less corn next year, 30-40 cent higher prices. If you're short on storage, let's look at corn over soybeans.
That less corn in 2017, 30-40 cent higher prices. Let's put this in perspective. They're still only talking 350 to 360 corn for 2017.
That's correct. Right.
You know, just for basis, that's what we're looking at for 2017. In December 2017.
And you'll probably tell us cost of production for 17 with normal yields would be higher than 350 corn.
Yeah, so it still puts a lot of pressure on.
Still a lot of pressure. That's the point I want to make.
The need to squeeze prices or squeeze production costs down. Chris, you know, one of the things that I think could differentiate as you move around the Corn Belt a little bit, we come into this, and here in the Eastern Corn Belt,
Sure.
Indiana in particular, parts of Ohio, we had a relatively short crop in this part of the Corn Belt last year.
Right.
A little less carryover in this part of the Corn Belt, maybe a little less pressure with respect to widening of basis at harvest. But as we move west and think about Illinois, Iowa, where we're looking at back-to-back large crops, maybe a little more pressure on the basis at harvest?
No, I think that's right. Again, the carryover stocks do make a difference, and we just don't have much because of 150 bushel corn yields in Indiana last year. So, and basis is not just totally local, it is influenced by a more national perspective and Midwestern perspective. So that's right, the bigger crops are still to the west of us this year. But again, very good crops overall in Indiana. Indiana was lowered 2 bushels, 185 bushels from 187. The 14 crop in Indiana was 188, 3 bushels higher than this crop.
So as you think about it, especially as we move west into the Corn Belt, it's probably a good idea to think hard about what your own individual storage situation is. And if you've got excess supplies, some corn that's going to need a home this fall, you might want to lock in basis now. Is that correct?
I think that's the way to bet. Will basis weaken or strengthen or stay the same going into harvest? At this point, I would tend to suggest that we would probably see the basis weaken further. And when the basis really weakens is when all the on-farm storage is full, most of the commercial storage is full, and then basically the grain system says, if you want to bring corn to town, we want you to price that corn. And that usually means they're going to buy that. There's just an excess supply relative to the demand, and you're going to really depress the basis price, that local price. So I would tend to suggest any corn that has to move, a basis contract on that would make some sense at this point. This is a pretty normal basis that we have in most locations in the Eastern Corn Belt. And then if a basis contract could be set over next July futures, many producers want the opportunity to move higher on price in case futures go up. So the basis contract would do that.
So it's an argument to really sit down and be honest about what you think yields are going to be. Look at your storage options.
Absolutely.
And if you've got some corn, and a lot of us I think are probably going to be in that situation where maybe that last 10% of the crop, maybe that last 20% of the crop is going to need a home.
Yeah, and I think the point you're making is plan. Plan. Now's the time to get that plan put together. We're a little bit late on the bean harvest. I think that's going to push the bean harvest and the corn harvest close together. The pace of harvest is also a key in how we handle the crop and what it's going to do to the basis.
All right, let's take a look at the soybean
Get the
side.
soybeans, and hey, more of the same, only worse. As we look at yields, 50.6 bushels, higher than any of the trade was guessing we would see. A lot of talk we'd be pushing towards 50, but not quite this high. So you can see the 3 years, most recent years, the 14, 15, 16 crops, all record yields and extraordinarily yields. We're probably close to 5 bushels above what we would have expected this year for a trend yield. So just absolutely wonderful yields. And as we look at the balance sheet, what does this do to the balance sheet? Let's start with the 15-16 marketing year and look at the exports. And USDA raised exports for the old crop by 60 million bushels. Now what's going on there is that USDA tracks weekly exports, but the Census Bureau, the United States Census Bureau, is the official estimate of how much clears and moves out of the country. And the census had been showing considerably more bushels had actually been exported than what USDA had on their reports. So this is catching up. We've been watching this all summer with this aggressive pace of soybean exports. So USDA was catching up, and this was pretty much fully expected that they were going to increase those exports by 60 million for the 15 crop and reduce carryout. So now here we have actually a pretty tight carryout. Look at the 14 carryout, about the same, 191 million with $10 beans. This year, same carryout with $9 beans. Let's go look at the projections this year. And first starting with the reduction of the carry-in by 60 million, and then that huge increase, 1.7 bushel increase in yield. That was 141 million more bushels of soybeans. Never saw a 4 billion bushel bean crop, but there it is, 4.2 billion. Going down then to the crush, increased that a little bit from the August estimate, and also increased exports 35 million bushels. So that gave our total use an increase of 35 and the carryover increased by 35, and USDA dropped the price at the midpoint by a nickel with a range from $8.30 to $9.80 a bushel, marking your average price, midpoint $9.05. So kind of another year of $9 beans on average.
A couple points there, Chris, that I want to point out. One is we have a relatively high soybean to corn price. If you look at last year, but particularly looking at 16, 17,
right.
The reason I bring that up, we're going to talk about this later in this webinar, is that there is an expectation that we'll increase soybean acreage at the expense of corn acreage next year. And part of that has to do with this soybean to corn price ratio that we're currently seeing.
And again, what the market is doing, soybeans have been relatively tighter in terms of world inventories than what corn is. And this should give a price incentive to beans over corn. And for the producer that you're going to be talking about, that price incentive towards beans should give some incentive to reallocate some acreage in the direction of soybeans for next year.
And then also the very wide range of prices there. Is that related to the uncertainty in the export market?
Well, that is uncertainty both on final production and what the demand structure is going to be. So as you think about that, we are going to market this crop September through August of 17. And over that now 12 months, a lot of things can happen. That can include major shifts in the production in South America on soybeans. It could make major changes in policy in China or other countries that might buy from us. It could be exchange rate factors. So again, I think, as we all know, when you're trying to predict something that's not going to be determined for almost a year out, you better take a fairly wide range around that. And we still have this yield uncertainty. It's better than it was midsummer, but still uncertainty of just what will those final yields be.
And
but
so
it looks very good.
When we think about the strength in soybeans relative to corn, I think it's important also to think back to the chart you had near the beginning, Chris, where you talked about ending stocks relative to usage.
Right.
And the ending stock to usage situation in soybeans is still quite a bit
That's
tighter
correct. That's correct.
than on the corn side.
Well, and here's that 365 looks like a big number for what we see here in terms of carryover. But again, if the Chinese are somewhat more aggressive, there could be another 50 or 60 million bushels, and suddenly soybeans continue to look fairly tight. But we've got a big crop here in the United States, not just a big crop, a big record, massive crop in the United States. And then the feeling is South America will plant more bean acres, maybe not Argentina, but Brazil certainly will. And we replenish the world supply with the U.S. crop, and then South America comes in with a normal crop. And that could be a scenario where bean prices really struggle after February.
Chris, let's take a look at the long-term price chart. You put one
yeah,
together.
Same as with corn. Here's about $8.50 on the downside on soybeans. And maybe, we haven't been at that level as we look to the very right-hand side. We're about, I think, November, 966 on November, around that level overnight. So we haven't pressed down to those 10-year lows on beans. Why is that? Relatively speaking, soybeans are not in much of a world surplus as what corn and wheat are.
And that's especially because of what took place in South America.
South America
this past
especially,
spring.
and that was about 220 million bushels of soybean production they lost, and we are picking up a lot of those exports right now.
And so that picture could change a lot this winter.
It could change a lot. We've got a lot of U.S. crop, and if South America comes back to more normal, we could be more locked in to around this $9 price, where we're hoping we'll get a shot at some $10 soybeans. But again, it tends to bias us to think about pricing beans more aggressively in the first 6 months of the marking year. That would be September through February.
And Michael, we'll come back to this later, but as we think about the possibility of shift in acreage from corn to beans, it also argues for, if you're going to do that, think about locking in some of those bean prices for 2017 as well, right?
Yeah, definitely.
All right, let's talk a little bit about grain storage, Chris.
Okay, yeah, so we're right at that point. We've got big crops throughout the Midwest, and what are we going to do with it? And so we want to look a little bit at storage situation. This is Indiana, and what we're looking at is an estimate we make of what is the size of the crop, how much carryover do we have, and how much capacity in terms of storage capacity do we have. And then trying to make an estimate. Again, these are just estimates, but I think we can look at them relative to the years. And we have this 103%. Essentially, that estimate is saying we're basically going to need every bushel of storage capacity we have in Indiana to tuck this crop away. We'd like to have a little bit more. That says we need more than 100%, but that's beginning to suggest you could delay harvest a little bit. You delay harvest a few days, and that could be that extra 3%. And so I think what this says, can we handle this size of crop? We go back to a couple units from that 103 to 2014, and that was actually a bigger Indiana corn crop than this one is. And we were at 107% of capacity. We handled that crop. We got through that year. We can handle this crop, but it's going to take every bushel and every facility operating at peak capacity to do that. Another point, I think, from this visual, last year, 87%. That was at 150 bushel yield in Indiana. We had roughly 13-15% of our grain storage capacity just not utilized last year. So that's good to get that whole segment back to work this year. So let's look at returns to maybe corn storage and bean storage and see how that stacks up. This green line are some rough approximations of bids for a central Indiana corn buyer, unit train shipper. About $3.15 in October, November, getting up to $3.52 as we get out to June. Now these are approximate, not any buyer in particular, but to show us the general tendency. We have a blue line on there, and that's taking the harvest price plus the interest cost for on-farm storage. So if you only charge your on-farm storage, the interest cost, we get out to June about $3.24 with a $3.52 bid. That says that the carry that the current market is offering, that $3.52 is 28 cents higher than harvest plus interest cost. So a return of about 28 cents is what the market's offering now on corn. Now if we look at that in terms of that cents per bushel. The blue line is for on-farm storage, just accounting for interest cost, return above interest cost. The red line below zero, that would be commercial storage, 15 cents flat a bushel to December 1, then 3 cents a bushel after that. And again, the market is not reflecting at this time enough stronger bids on out into the spring or summer to cover what would be accumulated storage cost. So commercial storage, this is often the case, does not look profitable. At least you can't resell the day you put that in storage at a price high enough out in the summer, spring and summer, to cover your storage cost. So it says if you want to store commercially, you're probably going to speculate for some higher prices. That certainly can occur. Other alternatives for those that would use commercial space would be sell at harvest and have your buyer replace some of that position with a futures contract, maybe go out to the July futures, or replace with a call option, and we'd mention the basis contracts, another possibility. Okay, let's look at soybean returns. And what we see here is those bids going from about 936 to 972 on out into the early summer. Again, about the same as the corn, around 35, 36 cents, but interest cost is more there, so going out to June, market's only reflecting about 11 cent per bushel return for soybeans with on-farm storage and just accounting for interest cost. And so this is reflected in the on-farm storage on the blue line, 11 cents out to June, little bit of return is what the market's suggesting. And the red line is commercial storage, does not look positive. You put beans in commercial storage if you're willing to speculate, and most of that price increase, if it comes, will come in the futures market. You can sell the cash beans, buy futures or buy call options, avoid the storage cost. And then if we compare corn and soybean on-farm returns, the blue line is corn returns on-farm above interest. The red line is soybean returns above interest. And again, making the point, if you're short of storage, it would the markets are suggesting corn storage will give a stronger return above interest than what soybeans would. So this sometimes helps some people think about more aggressive selling beans, more aggressive storing corn.
So Chris, we've really got multiple reasons to think about being more aggressive on selling soybeans versus corn, right? I mean,
that's correct.
More downside price risk is one concern.
Big competition from South America that we don't have nearly as much on corn, and the percentage odds of corn going up into the spring and summer are higher, probably going to bring corn acreage down as we talk about planting intentions in March next year. So I think, again, that helps strengthen 17 crop prices on corn, but not on soybeans.
Yeah. So let's kind of summarize on the soybean side.
Yeah, so it's a huge yield. This is remarkable. Certainly record crop and record usage. Inventories at 10-year highs. 905 USDA marking year price is what they're talking. Exports are going to be front-loaded, trying to compensate for those losses of bushels in South America. Then if we have a normal crop in South America, bean prices could really struggle as we see more exports shift to South America. The market carrying beans about 35 cents into the summer, about like corn, but certainly returns for on-farm storage are positive, but better for corn. And on beans, I think we've got quite a range here on price. We may not have seen the lows yet. If this crop comes in this size, we do have a lot of beans. And so I put high $8 that we still could push down to $9 on cash beans at harvest time, or even a little lower. And then on the upside, beans are always a surprise. A little weather scare in South America could get us back to the $10 mark. And I think a lot of producers are going to be looking at $10. If I can get $10 for beans, that's where I'd move them. More beans next year, and probably lower prices, 20, 30 cent lower prices.
Yeah, looking at the futures right now, adjusting for basis, right around $9 for November
crop.
2017 crop.
Right.
Yeah, so I think it's important to think about why we saw some of that strength in beans this past spring,
Yes.
and recognize that a lot of that came out of what was going on in South America. And if you want to bet on that same thing again, you're betting on another crop production problem in South America.
And it certainly can happen, but it may not happen.
That's right.
So I think, again, to bet all of the beans on that is a little bit dangerous.
Yeah. Michael, you're going to talk a little bit about production cost, and of course one of the keys there is on the fertilizer side. So you've taken a look at fertilizer prices this year versus a year ago. Let's take a quick look at those.
Yeah, this is quite interesting. If you haven't looked at these prices, comparing recent prices from the Illinois Production Cost Items Report to a report at the same time last year, and you can notice here that prices are anhydrous ammonia down 25%, urea down 30%. Phosphorus down 23% and potash down 36%. So some very large drop in fertilizer prices. Since 2013, we've taken $70 per acre off of fertilizer costs on corn, and so this has been one of the good news for corn production in the last year. Of course, a lot of the reduction in price that we're seeing here on this slide occurred from September 2015 to January 2016, but we also had some weakening even from January 2016 to the current period. That's kind of the good news, that production costs have come down because of lower fertilizer prices. The not so good news is how much lower can these really go? Most people would expect prices not to go too much higher than what we're seeing here on the screen, but not necessarily continued weakness. And so we've taken about $75 to $100 per acre out of corn production costs since 2013, probably closer to the $100 for corn. However, we needed probably another $75 to $100 out of production costs if we're going to get that break even closer to $350. I don't think that additional $75 to $100 is going to come from fertilizer, and so we're going to have to look at other places.
Yeah, we might get some of it from fertilizer,
Yes.
especially on the nitrogen side where
Yes.
natural gas prices are. Would suggest we could see some additional weakness there, but we're not going to get enough.
We're going to have to look at cash rent, maybe some continued weakness in cash rent, seed costs, machinery costs. People aren't buying machinery, and so as we depreciate some of the machinery cost ownership is going to go down, and then labor. So let's continue and take a close look at labor.
Let's look a little closer look at these cost estimates.
This is variable costs, overhead costs, and gross revenue. These are budgeted costs, so please keep that in mind. We've been in the red since 2014. We've been able to cover variable costs comfortably on rotation corn for average productivity soil, but we certainly haven't been able to cover all these overhead costs. And so what that means is there's going to be continued pressure to cut costs. And I named some of the ones that are high on the list: machinery, labor, cash rent, and probably seed cost of the four that we're probably going to focus on here in 2017, 2018.
Let's look at your projections for
Now,
earnings
this is
per
again
acre.
budgeted returns, and the earnings aren't going to improve any in 2017, and probably we're actually expecting 2017 to be even worse than 2015, 2016, and that's because when you look at 350 corn on average productivity soil, our break even is still closer to 430, 440. And so we're a long ways from break even on average productivity soil. Even on high productivity soil, we get those corn yields up to 200 and the bean yields up to 60. You're still looking at losses for a corn soybean rotation in that $75 per acre range for 2017. And remember, we're not going to talk about Ark County payments in this webinar, but remember that in 2017 we're not expecting an Ark County payment, so that's not helping us any here. But even on high productivity soil, we're expecting some pretty big losses. And so going back to what Chris was saying earlier, just this need to continue to look at cost.
So one of the things that you looked at, Michael, and we've been talking about this potential shift from corn to soybeans in 2017. So you've taken a closer look at that and started thinking about how we could equilibrate corn versus soybeans. And I think that's pretty interesting to look at. So you've got a chart here. Walk us through this a little bit.
So let me talk a little bit about how this was generated. We looked at the difference between corn and soybean costs, as we've got that factored in, and that has changed as fertilizer costs came down. Obviously, the difference between corn and soybean costs changes a little bit. And we've taken $100 off of corn cost of production, 40 out of soybeans, and so that changes. You need to reflect the fact that changes over time. And so we're looking at the budgeted difference between corn and soybean costs. We're also looking at corn and soybean yields, and then we're asking the question, if soybean price is X amount, what would we need? What would we need in terms of a corn price in order to encourage us to produce corn rather than soybeans? And so let's just look at the line I've got highlighted there. $9 soybean price is what we're currently expecting in the fall of 2017, looking at the futures and adjusting for basis. And so what this tells us, on low productivity soil, we would need a corn price of $3.95 or higher in order for us to favor corn over soybeans at a $9 soybean price. On high productivity, we'd still need a corn price of $3.73 in order or higher to encourage corn production rather than soybean price. And this is because of I think, because of this relatively high soybean to corn price that we're seeing right now.
And we're looking at maybe 350 to 360
yes,
would be the current
and so we're still
outlook.
looking at a situation in our current budgets where soybeans are favored.
And as you think about that, so we're likely to see a boost in acreage in soybeans in 2017. Thinking about that, Chris was talking earlier about some downside risk in soybeans, possibly as the crop might get larger, and also
Right.
what takes place in South America
Sure.
this winter. If you're thinking about making those kind of transitions, as you're making those plans, I think this argues pretty strongly for locking in
Yes.
some of those expected returns,
Yes,
right?
Definitely. And another thing that's important to point out here is in Indiana, the corn and soybean acreage has been relatively similar the last couple of years. And so this shift we're talking about is it's not going to occur in
no.
Indiana. We're
Right.
talking Illinois, Iowa, maybe eastern Nebraska, where you'll see some shift out of corn into soybeans.
And again, the shift is, a few percent of the
Yeah,
acres.
so
It's not
2 million.
Right.
2 million acre shift would be pretty large. I'm just simply making the point that there is this incentive to grow more soybeans next year, and it's something that producers, particularly in the Western Corn Belt, need to take a close look at.
And so one of the things that I think about when I think about shifting to soybeans versus corn, at least in the short run, is that takes a little bit of pressure, a little bit of financial pressure off because of the lower production cost. And so that might also encourage some modest boost in soybean acreage as we look at 2017 with this tremendous pressure on the financial side, right?
Yes, definitely the variable costs are very different between corn and soybeans. But one thing I would like to point out is cash rent makes up a bigger portion of total cost for soybeans, and so it actually increases the pressure to reduce cash rent to make sure that soybeans work.
Yeah.
If you look at corn, cash rent's typically about 30% of production costs over a long period of time, 30 to 33%. For soybeans, that's up to 40%. And so when you are growing soybeans, cash rent's a huge proportion of the total cost, and so it puts even more pressure, or focus like a laser on that cash rent that you're paying for soybeans, because to make soybeans work, you've got to reduce that cash rent.
It highlights the importance of that.
Yes.
I don't know that it creates more pressure, but we can discuss
And
that.
I would just throw out also that corn is the big input user, all these different inputs
Yes.
that go into it. And if you drop corn acreage somewhat, less inputs than you have on soybeans. And so the agribusiness sector gets some impact out of this as well. And the lender gets some impact
Yes.
because the cost to finance for the operating loan beans is just not as much as
Yeah.
what corn is.
Conservative.
Again, we're not talking huge shifts,
Yeah.
but I think these really do have some implications on the demand side for the input sector, including fertilizer.
Yes.
So I think to wrap up, it looks like another challenging year ahead of us with respect to returns, and we've been talking about this now for a couple of years. The challenge is to focus on our production cost, really examine every aspect of our operation and look for ways to reduce production cost without hurting yields. And there are some opportunities out there. I guess we've done some previous webinars with some of our faculty in agronomy talking about some ways that we can reduce production costs without hurting yields. I think there are some opportunities for us to do that. But the outlook suggests the pressure in 17 is going to be probably every bit as strong as it was in 16, and possibly more so, right, Chris?
Yeah, and I think probably we need to say this is the period we're in, that we have a a lack of equilibrium, as we call it in economics, between revenues and cost, and we just simply have revenues the market can't give us. It's seemingly where we're at now, a lot more on the price side. If we're going to narrow in those losses, our cost structure's higher than revenues. The one thing producers can always work on is work on the cost side. And as Michael mentioned, cash rents are one of the things that they can work on, among many things they can work on.
A lot of our costs ratcheted up during a period of very strong returns, and we know that it's a bit of a struggle. There's a lag with respect to reducing those production costs. We're in that period now. I think it's important to point out that when we look at the data from not just Indiana but around the Corn Belt, we are seeing cash rents come down. We are seeing land values start to back off. So we are seeing some adjustments take place, and now's the time, right, to have those discussions and start thinking about making those plans for 2017.
And in the 1980s, that took about 5 or 6 years for that adjustment to occur. And one of the things, if the world has to adjust, if the farm sector has to adjust, better that they probably, once they start that, work through that adjustment. Actually, 5 years would be by about the 2018 crop. 14, 15, 16, 17, and 18 would be 5 years. Much of this adjustment could be made.
Yeah, I think you're right. I think this time again we're going to have it see like a 5-year adjustment period. And when you look at the margins for 18 and 19, they're still not looking particularly good. Particularly if corn stays in that $3.50 to $4 range. We just have some cost cutting to get down to that $3.50 to $4 range for most producers. Now there's some producers that probably already have production cost break-evens that are in the high threes, but that's not the average, and so it's going to take us a while to work ourselves out of this situation from a margin standpoint.
Yeah. Well, with that, I think we'll wrap it up. Of course, as always, we've got a lot of information available for you on the web. I've got the website for the Center for Commercial Ag. We'll have a link to this webinar posted probably late this afternoon. And we also post a copy of the slides so that if you wanted to download those as well, you can do that and look at those in more detail. I've also got the website up for our Ag Barometer. And if you haven't checked out the Ag Barometer, that's our monthly survey of 400 farmers around the nation to get a little better grip on the economic health of the ag sector. And we ask a lot of other questions as well. And one of the things we've been focused on lately is people's perspective with respect to what's taken place with respect to input prices, land prices, et cetera. So you might want to tap into that as well. And so with that, I want to thank you for joining us on our webinar today and wish you a good day. Thank you.